Refinancing your mortgage means replacing your current loan with a new one, often with better terms. Many Americans refinance to lower their interest rate, reduce monthly payments, or switch loan types. In 2025, with changing interest rates and rising home values, refinancing can be a smart move, but it's not right for everyone. It's important to understand both the benefits and the risks before making a decision. This guide breaks down the pros and cons in clear, simple English so you can decide what's best for your financial situation. Let's explore when refinancing makes sense and when it doesn't. In this video, we will talk about refinancing your mortgage, pros and cons for Americans. So before we get started, make sure to hit the like button and also subscribe to our channel. 1. What is mortgage refinancing? Refinancing means replacing your existing home loan with a new one, often from the same or a different lender. Your new mortgage pays off the old one, and you start fresh with new terms, a new rate, and possibly a new payment schedule. People refinance for many reasons: to get a lower interest rate, change loan terms, tap into home equity, or switch from an adjustable rate mortgage to a fixed rate one. It's like hitting a reset button on your home loan. However, it's not free. There are closing costs, paperwork, and time involved, so it's important to make sure the benefits outweigh the costs. 2. Pro: lower interest rates. One of the biggest reasons people refinance is to get a lower interest rate. Even a small drop, like from 6.5% to 5.5%, can save thousands of dollars over the life of your loan. Lower rates reduce your monthly payment, which can free up cash for savings, debt payoff, or other needs. In 2025, if rates dip and you qualify, refinancing could be a smart way to save money every month. Just remember, to qualify for the best rates, you usually need a good credit score, steady income, and enough equity in your home. 3. Pro: reduced monthly payments. Lower interest rates often mean smaller monthly payments. Refinancing can make your budget easier to manage, especially if you're dealing with other rising expenses like food, gas, or childcare. In some cases, people also refinance into a longer-term loan, like from 15 years to 30 years, which lowers monthly payments even more. However, this might increase the total interest you pay over time. If cash flow is your biggest concern right now, refinancing for a lower monthly payment can give you some breathing room. Just be sure to consider the long-term trade-offs. 4. Pro: switch loan types. Refinancing gives you the chance to change the type of mortgage you have. For example, if you currently have an adjustable rate mortgage, ARM, you can switch to a fixed rate mortgage for more stability. Fixed rate loans stay the same for the life of the loan, which means no surprises. A big benefit if you're planning to stay in your home for a long time. On the other hand, if you're close to paying off your home, switching to a shorter loan, like 15 years, can help you save on interest. The right loan type depends on your future plans and comfort with risk. 5. Pro: tap into home equity, cash out refinance. If your home has gained value, you may be able to take out a cash out refinance. This means refinancing for more than you owe and getting the extra money in cash. It's a way to use your home's value without selling it. Homeowners often use this money for home improvements, paying off debt, or other major expenses. Since mortgage interest rates are usually lower than credit card rates, this can be a smarter way to borrow. But be cautious. Your loan amount and monthly payment will go up, and you're using your home as collateral. Don't cash out more than you need. 6. Con: closing costs can be high. Refinancing isn't free. You'll need to pay closing costs, which can range from 2% to 6% of the loan amount. On a $300,000 mortgage, that's $6,000, $18,000 in fees. These costs cover appraisals, title searches, credit checks, and lender fees. You may be able to roll them into the loan, but that increases your total debt and interest over time. Before refinancing, ask your lender for a loan estimate that lists all expected fees. Then do the math. Will the money you save each month make up for those upfront costs? 7. Con: restarting the loan term. When you refinance, you start a brand new loan, which often means extending your repayment schedule. For example, if you're 7 years into a 30-year mortgage and refinance into another 30-year loan, you're adding more years to your payoff timeline. This could mean paying more interest in the long run, even if your monthly payments are lower. Some homeowners don't mind this trade-off for short-term relief, but it's important to understand what you're giving up. If you don't want to restart completely, consider a shorter-term loan like 15 or 20 years when refinancing. 8. Con. Qualification may be tougher in 2025. Mortgage lenders have strict rules in 2025, especially with the uncertain economy. To qualify for refinancing, you'll need a strong credit score, stable income, and a solid debt-to-income ratio. If your credit has dropped or your income has changed, you might not qualify for the best rates or for refinancing at all. And even if you qualify, the rate you get may not be as low as you hoped. Before applying, review your credit report, pay down debts, and gather documents like tax returns and pay stubs to make the process smoother. 9. Con. Risk of resetting equity progress. Every time you refinance, you're adjusting your loan balance and starting a new timeline. This can affect how fast you build equity, the part of your home you truly own. If you choose a longer term or cash out some of your equity, it may take longer to pay down your loan and fully own your home. That can delay future financial goals like retiring or moving. Always weigh the short-term benefits of refinancing against your long-term wealth-building plans. Sometimes the best financial move is keeping your current mortgage. 10. When is refinancing worth it? Refinancing is worth it when the savings outweigh the costs. If you plan to stay in your home for a few more years and you'll save enough monthly to recover your closing costs, refinancing could be a smart move. You can calculate your break-even point, the number of months it takes for savings to cover closing costs. If you break even in 18 months and plan to stay 5+ years, that's a good sign. Talk to lenders, compare offers, and look at your full financial picture before making a final decision. The right timing makes all the difference. Refinancing your mortgage can be a powerful way to improve your finances, but only if the timing and terms are right. With potential savings on interest, monthly payments, or loan types, many Americans benefit from refinancing. Still, it's not without risk. Closing costs, new loan terms, and qualification rules must all be considered. The key is to run the numbers, understand the trade-offs, and plan based on your goals. This guide gave you the full picture in simple words. Whether refinancing works for you depends on your current situation, so take your time, ask questions, and choose wisely. What do you think about our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.